Hey traders, Jason here from Leavitt Brothers. Happy Wednesday. The market continues to deteriorate. The index is sold off at the beginning of the month. They paused for a couple weeks. Now they're selling off again. The warnings have been there. Okay, I've highlighted them in our daily and weekly reports at Leavitt Brothers. In fact, after the last Fed meeting, which was on May 1st, I announced that I'd gotten out of most of my positions. In this video, I'm going to do an update of my State of the Market series. Let's see what the index are doing. Let's see what they're telling us. What are the breadth indicators telling us? Let's check them all out. All right, so here's the S&P 500. Broke. Whoops. Don't want that. Broke an unsustainable trend line here, which is no big deal because you just can't expect that to continue. Rested for a few weeks. Formed a support line at 2,800, and now it is broken down, and now it's sitting right at the 200-day moving average. Measured move from here is to about 2,700, and after that is to about 2,650. Not making a prediction here, but if the market, if the S&P cannot get back above 2,800, if it lingers here of the 200, taking out the 200 would most likely lead to a quick plunge down to 2,700. It'd be below its 50, below its 200. A neutral trading market, it will be at that point turning down. Here's Russell 2000 support level. I guess you can put, say there's a support level here. Wasn't really checking that out. I was looking at this. At first I was looking at this. Tried to break out, failed. Then it took out this support line, took out the 200, took out the 50, got trapped under here, under both moving averages, and now it's moving down again. I don't really consider that to be strong support, but it's there. So now we're at, basically almost at a 4-month low. So a neutral situation, whereas, we had a big rally and then the market was trading in a neutral way, is now turning down. Okay, so uptrend turns neutral. Now it's turning into a downtrend. These moving averages will act as resistance on the way up. So even if you get a little bit further down here and then you get a bounce, these moving averages that are going to come in over here are going to act as resistance and probably reject price, at least on the first attempt. Okay, if they come down a little bit, can base and then make a second attempt, then the situation will change. But for now, trend is down and those moving averages are to be considered pretty stiff resistance. Here is the small cap chart. So we had a breakout here. We had a falling wedge pattern breakout, came up here, higher high, but then came off, traded below its 50, traded below its 200, formed like a little support level here, and now it's obviously down at like a 4-month low. Okay, so similar to what I just said, this was more bullish, but a bullish situation, boom, turned into a neutral situation, and now it looks like things are pointing down. And again, just like the small caps, those moving averages are going to act as resistance. I consider the 50 more important than the 200. So any type of bounce up to here is probably going to get rejected on the first attempt at the 50. And it's going to take not necessarily a double bottom, but it's going to take a little bit of a consolidation basing there in order to be able to regain its strength in order to make a second attempt. Okay, not a prediction, but that's what it's going to take. That's what it's very likely going to take. And that's going to take like a month to play out. So it's not something that's going to happen overnight. All right, longer term charts. This is the S&P 500 weekly and the Russell 2000 weekly. I consider the 50-week moving averages to be most important. You can see over here, the Russell tried to get above its 50 and then failed. Got above its 50 here for like 2 weeks, but then gave it back. Now at like a 4-month low. The 50 with the S&P, we're right there at support. Okay, so with the Russell, you get a little bit of move down and then it comes back up. It's probably going to get rejected by its 50 on the first attempt. The S&P, it's salvageable. Okay, it's dropped to its 50. It could bounce from here. But if we get a push down here to my first target of 27, my second target of 2650, then that becomes resistance on the way up. It's something to look out for. Small caps are weak. Large caps are holding up better. It's a battle here. which one's going to win. If we get a push here, then it kind of turns a neutral situation into a full-blown downtrend, and then there are many layers of resistance overhead that will have to be dealt with. All right, let's look at some indicators. Here's the S&P 500. In the middle, you have the 10-day moving average of the AD line. Down below is the AD line itself. Okay, as I've said before, when the market does well, the AD line, the 10-day of the AD line tends to oscillate in a range, mostly above zero, but there are dips below. That has been the case. Okay, I can draw a box like right here. So I'd say the current situation is salvageable, but the fact that it's like traded down here for so long is a little bit of a warning. I would consider this, the situation to be very sensitive. Okay, right now it is salvageable. We can move up here. Okay, but we're so close to the bottom of the box that we could very easily just plunge. And if we plunge, the S&P could easily drop 100, 150 points in a relatively short period of time. Okay, so very sensitive situation here with the 10-day. Then with the AD line itself, it's been flat for 6-7 weeks. It is now below its 50. Okay, definitely salvageable. It doesn't mean got to sell everything. Well, I've already said that. I've already done that. But it doesn't mean you have to panic. But if we do get a further push here, then on the way back up, the moving average, does something like this. The moving average becomes a resistance level, kind of like what happened over here, where we got to push down and then attempts to get back up. It took several attempts before we finally did it. So it's something to look out for. Salvageable situation, but very, very sensitive. It could break down at any point in time and turn, a neutral leaning bearish situation into a full-blown bearish situation. Here's the same chart with the NASDAQ. Situation is the same. Okay, it's been trading, the 10-day of the AD line's been trading in a box, salvageable, but not much room for error. The AD line itself has been trending down for a month. It's been below its 50 for a week or so. So any bounce attempts could get rejected here by the moving average and head south again. Something to watch out for. I consider the NYSE data to be more important or more telling than the NASDAQ data. Okay, so this is worse off than the NYSE. Still something to keep in mind. When you consider that the market was making new highs here, but the AD line over here wasn't up to where it was over there. Something to keep in mind. Okay, here is the S&P 500 versus the NYSE new highs and new lows. What I look for here is I like oscillations at a moderate, healthy level. I don't want too high, which is what happened here, because that would tell you that we're going to have that's like some sort of blow off top. You don't want too low, because that's a sign of weakness. What you want is oscillation somewhere in the middle, which tells you that participation is good, but not great. This is exactly what we're getting. So I would consider the NYSE new highs to be in good shape. The new lows are starting to ramp up. Okay, something, not urgent, not a reason to panic, but it's something to pay attention to. Same chart for the NASDAQ. Okay, I've noted this in other videos, in other state of the market videos. When the market does well, you get a surge in new highs followed by like neutral prints, and then a surge in new highs followed by neutral prints. And this is kind of normal, the normal yin and yang of the market, where you get a surge and then it backs off and rests, and then you get a surge and then it backs off and rests. And then when the market gets weak, you get these low prints. What we've had the last 4 months is that even though the market has been trending up and up and up, and we got like new all-time high, new highs have been pretty subdued. In fact, over the last month, they've been trending down. And then just recently, today, they broke down to their lowest level since early February, actually since late January. So participation at the NASDAQ has absolutely not been there. Even though the market's been trending up and up and up, new highs from the index, the new highs among individual stocks have been nowhere to be found, at least not up to what you would expect. Okay, it is a warning. And then the new lows have been slowly ramping up. Not reason to panic, but definitely notable. All right, S&P 500 up top, percentage of S&P stocks above their 20-day moving average. When the market is healthy, you get fluctuations above 50%. When the market falls on hard times, you get like huge volatile fluctuations, dips way down to single digits and then up into 70-80% range. So when the market was trending up here, January, February, March, April, you got fluctuations above 50%. That's exactly what you want. But lately, obviously, the indicator's fallen below 50%. A drop below 50% is perfectly fine as long as it recovers quickly. In this case, it has not recovered quickly. I've noted this every single week in my weekly report. This is an issue, okay? Hanging out down here with this few stocks trading above their 20-day moving average is an issue. Like the other indicators, I can argue that it's salvageable, but at this point in time, I'm kind of hoping for something like this. I'd rather have a complete washout where we get some pain and we get some like lower prices. I'd rather have that than to try and salvage the situation as is. So anyways, this is bearish. The market can try and salvage it, but until it does, I'm going to call it as I see it. And what I see is I see a bearish situation. I see, as long as you have less than 50% of stocks trading above their 20, the market is going to lean down. Okay, same chart with the 50-day moving average, so it's a little bit longer term. Similar concept. When the market's doing well, you get oscillations above 55%. The fact that the indicator's hung out down here below 55% all month is definitely a warning. And again, let's call it as we see it. With participation being this low, okay, you at the very least, if you don't go short, that's fine. If you're not a bearish, that's fine. If it's against you to go short, or you don't want to go short, or you're not comfortable going short, or you can't go short because of like the type of, if you're trading within a vehicle that doesn't allow you to go short, that's all fine. But as long as this indicator is below 55%, you shouldn't be aggressively going long. Okay, and that's what the situation is right now. Okay, same chart with the 200-day moving average. The absolute value is fine. Okay, it's above 50%. The trend is down, which is okay. You tend to not run into too much trouble until it drops below 50%. Okay, so if you look back to say like last January, a year ago January, we had this big plunge in January, and we still had prints here, 55%. Even when we had the second drop down to here, you still held the low at 50%, and then market recovered. Okay, compare that to October, where we had the big plunge, but then we had prints below 50%. Okay, and then of course what happened. So right now, if we do get, if we fall to, that's not what I want. If we do get a drop to 2,700, maybe 2,650, what I'm going to want to see is, can this indicator hold up here? Can it hold up above 50%? Okay, if it could hold up above 50%, then I'm thinking we're going to have a repeat of last early summer, where the market falls hard, but then it recovers. But if it falls much below, if this kind of comes down here and falls much below, then I'm going to start thinking in terms of having a repeat of October, November, December, where we're going to have a bigger move down. Okay, two more charts really quickly. Bullish percent. Somewhat worrisome that with the market trading at a new high here, the bullish percent only got to here. When you compare that to other high prints over the last couple of years, now we're below 50%. Salvageable, not a big problem. We had dips down here that were recovered from, but if we get a bigger move down, kind of like what we did in October, then there's a warning. So reason to panic? I don't know. Maybe not panic, but we're certainly at that point where there's very little room for error, that the market needs to bounce, or else a little bit further move down here is probably going to open the floodgates. One more chart. Nasdaq bullish percent, same as the last one. Similar in concept. This one actually did much worse. Despite the Nas being at an all-time high here, the bullish percent completely failed to move up much beyond the mid 50 range. You compare that to the last couple of years, it definitely was a warning. Now we're well below the 50, well below the level that I consider to divide bullish and bearish markets. So again, we're in a situation where it's like pretty sensitive. Okay, we have, if you look back to like 2016, where we also didn't have very high prints. We got print, and then we got drops below the red line here, but they were recovered from. So we're at that point right now where we could recover. That's fine. But if we get a further move down, then the market's going to fall much harder. Okay. So again, sensitive situation, not much room for error. Okay, so overall the market is not in great shape. The indexes are breaking down and now have several key moving averages on different time frames that will act as resistance on bounce attempts. The market's breadth is not great either. The 80 lines are salvageable, but have very little room for error. New highs at the NYSE are holding up, but at the NAS they've broken down to a new low. The percentage of stocks above their 50 and 20-day moving averages are hanging out in bearish territory. The market seems like it's on edge. It could very easily hit a downside air pocket here and plunge. I've been warning at Lever Brothers to be careful, that it wasn't time to be a hero, that we needed to be super conservative because the stage was not set for higher prices. Even if Lever Brothers subscribers haven't made much money on the short side, if that's not what they do, they were adequately warned. That what has happened over the last month was coming in the pipeline. Thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here at YouTube and be alerted of new content when it's posted. Come check us out at Lever Brothers. We're a boutique research firm that's been in business since 2002. We provide market analysis and trading ideas to institutional and individual traders and investors. Again, thanks for listening, and I'll see you next time.